The market is absolutely crashing, and investors are looking to buy the dip on many different stocks. However, knowing what not to buy is just as important as knowing what to buy, if not more important. In this video, we are going to discuss 3 stocks that I think are not stocks investors should buy, despite them continuing to fall. I am also going to use Stock Unlock to show you exactly what to look for so you can avoid some serious losses in your own portfolio. This is going to be a very educational video, so if you are someone who was looking to improve your own investing, then this video is for you. So with that being said, let's now head over to Stock Unlock, and the first stock that we're going to talk about is FUBO. In my opinion, this is not a stock that I would be buying at all, no matter how cheap it gets. It's even down 11% on the day today, but still I would not be buying it. Also, this is a stock that is being talked about a lot on YouTube right now. Still, I want to talk about why this is a business that I would not be buying. So the first thing we're going to do is head over to our Stock Unlock Insights, and right here we can see that FUBO has a profitability score of only 1.3 out of 5, which is almost as bad as it can get. 1 out of 5 is the lowest possible score here. Right here we can see that FUBO has a negative operating margin, negative net margin, negative free cash flow margin. It's unprofitable, it's free cash flow negative, and even its operations are losing money. And in the past year, the operations have lost $323 million. So the operations of this business are losing hundreds of millions of dollars, and it's not even close to generating any profits at all. Now, if we scroll down, we can also see that the financial health is only a 2.2 out of 5, which is pretty bad. The current ratio is 1.4, so the company does have enough current assets to deal with its current liabilities, but its intangible assets make up 60% of the total assets on the balance sheet. So a large portion of this company's assets are not real and they're intangible. We can also see that over the past year, the shares have increased by 32%. That is a significant amount of dilution to shareholders. This is very bad. However, we can see that the company does have more cash than current liabilities. So again, it doesn't look like it is going to be in any financial stress, at least over the next year. And it does have enough cash to deal with its liabilities right away. But the tangible book value is negative. So that's why intangibles having a large portion of the company's total assets is a bad thing, because when you take those out, the company does have a negative tangible book value. Now, if we take a look at growth, the score is a 2.6. So the company's revenue did increase by over 100% over the past year. That is good, but it's not profitable revenue growth. Again, this company is burning hundreds of millions of dollars to grow their revenue, which is not a very good thing. We can also see that the net income did increase, but the net income is still negative, so it is still an unprofitable business. The free cash flow decreased by 70%, book value went down, and tangible book value declined by about 186%. So that's not very good to see at all. If we take a look at the returns of this business, it's a 1.0 out of 5, literally as bad as it can get. ROIC is negative 60%, ROCE is negative 43%. And these two numbers right here tell us that the business is not investing its cash wisely into growth. It's not getting any positive returns on the cash that it keeps within the business and invests in itself. So again, it's not investing, or it's not able to invest in profitable growth. So what I see is a business where the revenue is growing, but the cash, it's just burning cash to grow that revenue, and the financial health isn't that strong, and it's got a long way to go before it reaches profitability. Let's go and take a little bit of a deeper look into this company's revenue, because if we take a look at the trailing 12 months revenue, it's been growing quite substantially, and we can see that the revenue is taking off. However, if we take a look at the quarterly revenue, in the most recent quarter, the revenue actually dropped, and it dropped by about 10%. This is not good to see in a business that looks like it is really relying on, strong revenue growth. And the net income is declining. It's negative $475 million. Now, if we head over to the cash flow statement, we can see here that the cash from operating activities is continuing to decline. So the revenue is growing, but the cash from operations is declining as the revenue grows. And this is what I mean. It's not profitable growth. So as the business grows its top line, it's just burning more and more money to do so. Now, if we also take a look at the free cash flow, it was negative $335 million in the trailing 12 months. So this is how much money the company literally burned, $335 million. Now, if we head over to the balance sheet, we can see that the total cash position of this company kind of just spikes out of nowhere, and then it kind of looks like it declines and then spikes again and then declines. This is because the company is losing money, and how it is gaining money is through dilution. That's why the shares increased by over 30% over the past year, and it takes on debt. So this company, since it is not generating any cash internally, it has to take on debt and do dilution to continue affording its expenses and really staying in business. Now, take a look at this. We're going to take a look at the net common stock issued right here. And in the trailing 12 months, this company has issued $150 million of dilution. It's done $150 million of dilution. And here in 2021, it did $281 million of dilution in the trailing 12 months. So this company is diluting hundreds of millions of dollars worth, right? And if we go over and take a look at the market cap, it's an $850 million company today. So if it has to dilute, $150 million again in the future, that's going to be like 20% dilution to shareholders. And you got to think about this. This company is burning like $300 million a year. That's almost half the company's market cap. And it cannot continue burning this much cash without having to continue diluting in the future. Like if this company burns $300 million a year, at the market cap it's at today, that's almost 40% dilution just to stay in business. That is insane. This is the type of business right here that I would personally be avoiding, especially if we do enter a recession or an economic downturn. Businesses that cannot afford to stay in business organically and they're not generating any cash flows for themselves are going to be in a lot of stress, and they're going to be incredibly risky investments, because they're going to have to take on debt, and money and debt is becoming more expensive right now. Interest rates are rising, or they're going to have to dilute while their stock is literally down. What is this? It's down like 85% from its all-time highs. So if the company has to dilute while the shares are down 85%, it's going to absolutely destroy shareholder value. So FUBO is a perfect stock right here. It's a perfect example of a stock that I would just be avoiding. Now, the next stock is Peloton. This stock is down massively from its all-time highs. It's down like 90%. It's down another 9% on the day, and I would still not be buying this stock. So let's go and take a look at our stock unlock insights. We can see that this business has a growth score of 1.0 out of 5. Its revenue is decreasing, net income is decreasing, free cash flow is decreasing, book value is decreasing, and tangible book value is decreasing. So basically every single metric that investors care about is going down on Peloton. It's not good. This literally as bad as it can get. Profitability is also a 1.4 out of 5, which is almost as bad as it can get. Gross margin is bad at only 20%. Operating, net, free cash flow margin are all negative. The company is unprofitable. Its free cash flow negative. And its operations burned $2 billion over the past year, okay? So this company's business is declining. It's literally losing revenue at the same time as it's losing tons of money. This business is not in a strong position at all, just by taking a look at the growth and the profitability. If we head over to the financials and we go over to the balance sheet, we can see that Peloton gained a lot of cash right here at the first quarter of 2021, and it was sitting on about $2.7 billion of cash. Now this business is literally burning like $2 billion a year. Its operations are losing billions of dollars. So its cash position is consistently going down. And the reason that you see these spikes in cash position is because it's doing dilution or taking on debt, just like FUBO was. So this is another clear example of a business that I would not be buying, even though it's down 90%, because yes, it has a $3 billion market cap, but the underlying fundamentals of the business are declining. The revenue is going down, and it's burning $2 billion a year, and it's not seeing any growth or any fundamental increase for that large cash burn. It's just honestly kind of insane. Just another business that I would not be buying at all. Now, the third one here is Beyond Meat. So if we take a look, this stock was once worth like $190 a share. Today it's selling for $18 a share, so it's another stock that is down 90%. This company was very popular last year, and they make fake meat. They're like plant-based processed meat. So that whole vegetarian movement, this stock was like leading it. This company was leading it. However, the fundamentals of this business, I think, are very poor. Right here, we can see that Beyond Meat's profitability has a score of 1.4 out of 5, just like Peloton. The gross margin is only 7%, okay? So it's not even close to becoming profitable. Operating margin is negative 65%, net margin negative 72%, free cash flow margin negative 117%. It's also burned $543 million over the past year. For this $500 million that the company burned over the past year, its revenue only grew by 2%. So it's not growing profitably, and it's just burning literally hundreds of millions of dollars. The net income also decreased, free cash flow decreased, book value decreased, and tangible book value decreased. Now, this is the same story if we go over to the company's financials. but it has a little bit clearer of an image. So let's take a look at the company's total cash position. So right here, we can see that they got this cash influx in 2019. They got up to $312 million in cash. And then over really like the next year and a half, it burned through that cash position, okay? And then in the first quarter of 2021, they magically just got this $1 billion influx of cash. This is because the company did, it took on about $1.2 billion of debt. So it leveraged up the balance sheet and it got cash. But take a look at what's been consistently happening to that cash position. Every single quarter, it continues going down. Literally had $1.13 billion in the first quarter of 2021. And now in the second quarter of 2022, the company only has $455-ish million left. So it's burned like $700 million since they raised money in the first quarter of 2021. If we take a look at the company's cash flow and its its cash from operating activities, we can see that it's still at negative $416 million, and it's still burning hundreds of millions of dollars on its operations. If we take a look at the free cash flow, same story. This company is burning hundreds of millions of dollars a year. So what I think is going to happen here is Beyond Meat is going to continue burning through their cash position. The cash position is going to continue going down, and they're going to have to dilute or take on even more debt to stay in business. But this business is still not anywhere close to achieving profitability, so it is incredibly risky for shareholders because it's just burning cash, and it's going to raise more money to leverage up the balance sheet and then burn that cash as well. The theme here, but with all three of these companies, is they do not generate any profits internally, and FUBO is growing its revenue very nicely. 100% year-over-year revenue growth, but it's burning so much money to do that, and it's diluted its shareholders by 30% over the past year to grow that revenue. And this is a trend that cannot continue. And while these stocks are down 90%, dilution is seriously going to eat shareholder value. I think that just because these stocks are all down like 90% does not make them buys. And they got to get to profitability and be able to afford and fund themselves internally, especially in this macro environment that we are in. So those are the three stocks that personally I would not be buying, even though they're down massively. And that's the reason why. Those are the key fundamentals that as my own investor, I take a look at. I got to see a company that's able to finance itself organically and internally. And right now, I would not be relying on a business that has to dilute or take on a lot of debt to stay in business. I think that's going to add a lot of risk to you as the investor, especially in this time that we are in. I hope that this video was helpful and valuable to you. And if you did enjoy this video, then please remember to leave a like on it. I really appreciate it. And if you guys want to subscribe to the channel and see more stock market related content like this, then please do so. If you are interested in Stock Unlock right here, the stock analysis and educational platform, then you can get a 14-day free trial by clicking the link at the top of the description. Seriously, just by checking out our Stock Unlock insights right here, you can avoid some seriously bad investments and find better investments and ultimately become a better investor. Just in a few minutes by taking a look at our insights. We point out everything that is bad and we point out everything that is good so that you can make more informed and more profitable investment decisions. Check out Stock Unlock using the link at the top of the description. You do not need a credit card and you can get 2 weeks free and come and play around with our platform. So check it out, and thank you guys again so much for watching. I truly do appreciate it, and I really hope to see you all again in our next video.